64% of Americans will never fully retire. Not because they were lazy, the math was never in their favor. The average American age 55 has saved $134,000. That covers about 4 years of average retirement expenses. Then what? An hourglass. Your savings draining out. No refill button. Social Security pays the average retiree $1,900 monthly. Average monthly retirement expenses run about $4,000. Do the math. $2,100 short every single month. That gap is your problem. The pension was supposed to fill that gap. It's almost gone. In 1979, 62% of workers had pensions. Today, it is 11%. The switch happened in 1978. One tax code change. Everything shifted. They called it employee empowerment. It was a cost transfer. Employers saved trillions. Workers got a savings account they had to fund themselves. And only 56% of Americans even participate in a 401k. Of those who do participate, the average balance at retirement is $212,000. At 4% withdrawal, that's $8,400 a year. $700 a month. That is what decades of 401k contributions buy you. This is not a discipline problem. It's a structural problem. You can't save your way out of a broken system with willpower alone. But you can play the system from the inside. That's what this is about. The target number most people never calculate. $1.3 million. That generates $52,000 a year at 4%, livable. Barely. Most people don't have $1.3 million. Most people have zero. The Federal Reserve says 50% of Americans have no retirement savings. None. 2 roads. Same starting salary, radically different endings. Meet Marcus, earns $60,000 a year, saves 15%, invests in VOO. Meet Derek, same salary, same age, saves 3%, spends the rest. Same income, 30 years later, Marcus has $1.4 million, Derek has $80,000. The difference wasn't income, it was the savings rate and the starting date. Compound interest is a boulder rolling downhill, slow, then unstoppable. $1 invested at 25 is worth $10 at 65. At 10%, wait until 35? That same dollar becomes $4, not 10. Every decade you delay costs you 60% of your final number, minimum. You cannot buy back time. That's the only truly non-renewable retirement resource. The good news? The math works forward from wherever you are right now. $500 a month at 40 earns you $360,000 by 65. $1,000 a month at 40, $683,000. Still real money. Most people spend $1,000 a month on things that vanish by Tuesday. The person driving a 10-year-old car with no payment is funding the math above. Stealth wealth looks boring on the outside. The portfolio tells a different story. Visible wealth is often borrowed wealth. Real wealth is quiet. 43% of Americans carry credit card debt month to month. Average balance, $6,000. At 24% APR, that $6,000 costs you $1,400 a year in interest. That $1,400 invested for 25 years at 10% becomes $15,000. I'm about to show you the account structure they never teach in school. Stay in your seat. 3 accounts. Used correctly, they legally minimize your tax burden for decades. First, your 401k. Contribute at minimum up to the employer match. That's free money. The average employer match is 4% of salary. On $60,000, that's $2,400. Not capturing that match is leaving a 100% return on the table instantly. Second, Roth IRA. $7,000 a year. Tax-free growth. Tax-free withdrawals at retirement. $7,000 a year at 10% for 30 years becomes $1.2 million tax-free. Peter Thiel turned his Roth IRA into $5 billion. Legally, tax-free. You won't hit $5 billion. But $1.2 million tax-free changes your retirement completely. Third, taxable brokerage account. No contribution limits. VOO, VTI, SCHD. Long-term capital gains rates apply. A sapling rooted in compound interest doesn't look like much at year 5. Year 25 is different. VOO tracks the S&P 500. Average annual return, 10.7% since inception. VTI adds small and mid-cap exposure, slightly more diversified, same low expense ratio. Marcus puts $400 a month into VOO inside his Roth IRA. Derek doesn't know what a Roth IRA is. SCHD focuses on dividend growth, average yield 3.5% plus price appreciation. Dividends reinvested accelerate compounding. You're buying more shares that also pay dividends. Your income is not your wealth. Your savings rate is. This changes everything. A 20% savings rate on $60,000 beats a 5% savings rate on $200,000. Over 60% of six-figure earners live paycheck to paycheck. High income, no savings rate. Lifestyle inflation is the silent savings killer. Every raise gets spent before it's invested. The fix? Automate your savings rate increase every time you get a raise. Match it dollar for dollar. Automate everything. Monthly transfer on payday. The money moves before you can spend it. Behavioral economics shows automated savers accumulate 3 times more than manual savers. Vanguard data, the best investment account isn't the highest return. It's the one you actually fund every month. Expense ratios matter more than most people realize. This is where the system quietly takes your money. A 1% annual fee on $200,000 over 30 years costs you $170,000. VOO expense ratio 0.03%. The average actively managed fund 1.0%. That difference compounds. 30 years, $200,000 invested. You keep $170,000 more with the index fund. Over 90% of actively managed funds underperform their benchmark index over 20 years. Morningstar data. You're paying more to get less. The only person who consistently beats the market is getting paid by your fees. Diversification is not owning more, it is owning less of the wrong things. A 3-fund portfolio: VOO for U.S. equities, VXUS for international, BND for bonds. That's the whole game. Adjust the bond allocation by age. A 25-year-old needs 10% bonds at most. Rebalance once a year. That's it. 30 minutes annually is enough active management for most investors. Hit subscribe. YouTube won't show you the rest. I'm serious about the next part. Everything I've shown you, that's the foundation. The real leverage is what comes next. Here's what nobody is telling you. The real wealth engine isn't the stock market. It's the tax code. Tax loss harvesting. Selling a losing position to offset a winner's gains. Legal. Effective. Most investors ignore it. Long-term capital gains rate for most Americans, 15%. Short-term, your ordinary income rate. Patience pays. Selling after 1 year and 1 day instead of 11 months saves you potentially thousands per transaction. Compound interest is a boulder rolling downhill. Taxes are the friction. Reduce the friction. The backdoor Roth IRA. If you earn too much, you contribute to a traditional IRA, then convert it. Income limit for direct Roth IRA contributions in 2024. 146,000 single, 230,000 married. Above those limits, backdoor conversion is legal. The IRS doesn't care. They just want the conversion tax. Health savings account. Triple tax advantaged. Deductible contributions. Tax-free growth. Tax-free medical withdrawals. Max HSA contribution in 2024, 4,150 single, 8,300 family. After 65, the HSA works exactly like a traditional IRA for non-medical withdrawals. 2 accounts in one. Marcus has an HSA invested in VTI, saves every medical receipt, waits 20 years to reimburse himself. Tax-free cash. Derek spent his HSA on copays as they came in. 0 invested, 0 compounding. Same income. Different systems. This is what separates the 45-year retired from the 70-year working. The order of operations matters. Fund in sequence, 401k match, HSA max, Roth IRA max, taxable brokerage. This sequence legally maximizes tax-protected space before exposing any dollar to capital gains tax. Most financial advisors won't tell you this sequence. It minimizes the assets they can charge fees on. Their incentive is assets under management. Your incentive is retirement. These are not the same goal. You are the chief financial officer of your own life. Act like one. This is where it gets interesting. The withdrawal phase is where most retirement plans silently fail. Sequence of returns risk. Retiring into a bear market early can permanently reduce your retirement income. The fix. Keep 2 years of living expenses in cash or short-term bonds at retirement. Never sell equities in a down market. The 4% rule has survived every market cycle since 1926. Based on Trinity study data, at 3.5% withdrawal, the portfolio historically has lasted indefinitely. Inflation adjusted, you think you need to time the market, you don't. Timing the market beats timing the market. Every study says so. Missing the 10 best days in the market over 20 years cuts your returns in half. Fidelity research. And the best days almost always come right after the worst days. That's when most people sell. Your emotions are the biggest risk to your portfolio. Not the market, not inflation, you. Dalbar data. The average investor earns 4.7% less than the market annually due to behavior. You now have the entire map. What you do with it in the next 10 minutes determines your retirement age. Here is the complete system. Step 1. Build a $1,000 emergency fund before touching investments. Step 2. Eliminate all high-interest debt above 8% APR. That is a guaranteed 8% return. Step 3. Fund 401k to capture the full employer match. Every dollar. No exceptions. Step 4. Max the HSA if you have a high-deductible health plan. $8,300 for families in 2024. Step 5. Max Roth IRA. $7,000 annually. VOO or VTI inside. Set, automate, ignore. Step 6. Additional 401k contributions beyond the match, up to $23,000 annually in 2024. Step 7. Everything beyond that goes into the taxable brokerage. VOO, VTI, SCHD. Long-term hold only. That is the entire 7-step system. No day trading, no crypto gambles, no newsletter subscriptions required. This isn't complicated, it's just not exciting. That's why most people skip it. Boredom is a feature, not a bug. The investors who check their portfolio daily earn less than those who check quarterly. The boulder is rolling. Compound interest accelerates the longer you stay out of the way. Let me show you Marcus's actual numbers at retirement. He started at 25, contributed $500 a month. At 65, Marcus has $1.4 million in his Roth IRA and 401k combined. Tax advantaged. At 4% withdrawal, that's $56,000 a year, plus Social Security. He retired at 62. Derek, he's 71, still working. His 401k has $82,000. No HSA, no Roth. Same salary for 40 years. Different systems. The system was the only variable that mattered. If you are starting late, the math still works. It just requires a higher savings rate. Starting at 45 with $2,000 a month at 10% still builds $680,000 by 65. The catch-up provision lets those over 50 contribute an extra $7,500 to a 401k annually. The fence you build today keeps the wolves out tomorrow. Compound interest is the fence. The Social Security full retirement age is now 67 for those born after 1960. File early and you lose permanently. Filing Social Security at 62 versus 67 costs you 30% of your benefit permanently. Wait until 70? Your benefit increases 8% per year from 67 to 70. Guaranteed. Waiting from 67 to 70 adds 24% to a lifetime guaranteed income stream. Risk-free. The break-even age between filing at 67 versus 70 is around 80. Most Americans reach 80. Inflation is the silent tax on savings. 3% annual inflation halves purchasing power in 24 years. Cash sitting in a savings account at 1% loses value every year. Inflation-adjusted returns are negative. VOO has beaten inflation by an average of 7.7% annually after inflation. Real returns matter. The enemy of compounding isn't bear markets. It's panic selling during bear markets. Stay the course. The boulder doesn't need your help going downhill. It needs you to stop throwing rocks in its path. Real estate can complement the portfolio, but it is not passive. Management, vacancy, repairs, eat returns fast. REITs give you real estate exposure without landlord duties. VNQ has averaged 8.4% annually. iBonds protected savings from the 2022 inflation spike with 9.62%. They have limits, though, $10,000 per person annually. Tips: Treasury inflation-protected securities are another tool. Yield adjusts with CPI automatically. The core of the portfolio stays VOO and VTI. Everything else is a satellite. Don't reverse the order. Most people complicate portfolios to feel in control. Complexity is not sophistication. Discipline is. The benchmark is simple. Are you saving more this year than last year? That's the only metric that matters early on. Track net worth quarterly, not daily. Daily tracking creates emotional noise that destroys rational decision-making. Your net worth statement: total assets minus total liabilities. Review it quarterly, update it annually. 1 year from now, you will either be 12 months ahead or 12 months behind. The decision is made today. The retirement crisis is real. But it is not inevitable for you if you use the system I just showed you. 64% of Americans won't fully retire. You now know why, and you know the way out. Marcus is 62 today.